Welcome to Talk Tickers. We dive deep into earnings calls to pull out the insights you need nice and quick. Today, we're tackling United Community Bank's UCB and their Q3 2025 call. Yeah, our goal here is really to sift through all the noise, figure out if UCB actually found a way to boost profits, despite this really challenging environment for banks right now. Margin pressure, funding costs. It's tough out there.
And, well, first impressions, absolutely. They posted a really strong, clean beat. It looked like it came from the core stuff, margin, loan growth. The market noticed, too, stock jumped at the open. But here's the interesting part, the puzzle we need to unpack for you. That initial pop, it just fizzled out. The stock ended the day pretty much flat, maybe even slightly down. So we got to dig into that gap, strong numbers, but sort of May market reaction by the end. That's where the real story is.
Okay, right. Let's lay out those numbers that caused the initial excitement. Operating EPS. 0.75 cents. That easily beat the $1.07 in consensus. So a solid 5-cent beat there, and wow, 32% better than last year. And total revenue, $276.8 million. That's up 27% year over year. The CEO kept it simple, basically said solid loan and deposit growth and healthy margin expansion were, the two main drivers.
Exactly. And you see that quality filtering down into the key metrics. Operating ROA, return on assets, hit 1.33%. And ROTCE, return on tangible common equity, was 13.6%. I mean, those are pretty impressive figures right now. And look at the capital side, too, for a signal of confidence. Tangible book value, it grew about 59 cents in the quarter. Now sits at $21.59. You put that capital bill together with their efficiency, the operating efficiency ratio actually improved to 53.1%. It shows they're not just growing, they're focused on profitable growth.
That efficiency focus, that leads us straight to the big story here, doesn't it? The net interest margin. They actually expanded it 8 basis points sequentially, landing at 3.58%. Given what everyone else is facing, how surprising is that expansion, really?
It's definitely a standout performance. And it really boils down to managing their funding costs effectively. The CFO made a point of saying they actively worked on bringing those costs down during the quarter. Cost of deposits fell to 1.97%, and even better, averaged 1.92% just in September. And because they did better than expected there, they actually updated their deposit beta guidance. That's how much of the Fed hikes they pass on. They now expect it to be in the 40% range through the cycle, up from the high 30s. Now, that sounds higher, but it actually means they think they've locked in cheaper funding better than they initially planned for the long haul.
Okay, so that success on the funding side fueled the asset growth, right? How strong was that loan growth? Was it risky?
Well, loan growth kept up a pretty solid pace, 5.4% annualized. That's about $254 million added. And remember, they're letting some senior care loans run off intentionally. So if you exclude that, the growth was actually 6.2% annualized. Strong, definitely. And importantly, it wasn't concentrated. It was spread across Florida, South Carolina, North Carolina. The key areas were C&I, equipment finance, and ELOCs, home equity lines of credit. And crucially, the deposits grew too. Core customer deposits were up $137 million, about 2.6% annualized if you strip out the seasonal stuff. That shows real relationship banking strength.
Let's focus on those ELOCs for a second. That wasn't just random growth, was it? Sounds like they made a specific push there.
Oh, absolutely intentional. They actually reorganized earlier this year to put more focus on retail lending. They ran a campaign, and this is key. They said 100% of their branch managers are now originating loans. That wasn't the case before.
Wow, that's a big operational shift. And you can see why when you look at the math they shared. New loans are going on the books around 7% yields, but new CDs, they're costing them maybe 3.2% to 3.30%. A 7% asset funded by a 3.2% liability, that's a recipe for strong margins.
That's exactly the engine driving that immediate margin lift. Now, moving beyond just the operations, you have to consider the other big confidence signal, what they did with their capital. Management made some very concrete moves here. First, they redeemed all their remaining preferred stock. That's about $88.3 million off the books. It simplifies the capital structure, gets rid of that future preferred dividend payment. Good news for common shareholders.
And at the same time, they bumped up the common dividend right to $0.25 a quarter. That's a 4% increase from last year. So redeeming preferred, raising the common dividend, it feels like they're signaling they're pretty comfortable, especially with capital ratios looking strong. CET1 came in at 13.4%.
Very strong. And they laid out their capital priorities clearly. Number 1, organic growth. Number 2, the dividend. 3, M&A, if the right deal comes along. And 4th, buybacks. But this brings us right back to that market reaction puzzle. If everything looks this solid, why did the stock give back its gains?
Yeah, it probably comes down to the near-term picture they painted for Q4, specifically on the NIM again. You got to face the fact that deposit costs are catching up, at least for a bit. They guided Q4 NIM to be, well, flat to maybe down 2 basis points.
Yeah.
And there's a concrete reason. They've got $1.8 billion in CDs maturing in Q4. Those were priced around 3.60%, and now they have to reprice them higher. That's a real short-term pressure point the market likely latched onto.
Exactly. That's the near-term noise. But the signal, the thing the market seems to be maybe missing, is the powerful medium-term tailwind. They have about $1.4 billion in older assets loans, securities rolling off over the next year. Those are currently yielding around 4.93%, much lower than current rates. So as UCB takes that $1.4 billion and reinvests it at these new higher yields like the 7% we talked about, that sets them up for a pretty significant NIM boost that should really kick in through 2026. That's the structural story perhaps being overlooked right now.
Okay, and looking out to 2026, what about costs? Did they give any color on keeping that operating leverage going?
Yeah, they did. For Q4, they expect operating expenses to be flat compared to Q3, mainly because variable comp will normalize a bit after a strong quarter. But after that, they see expenses growing in the 3% to 4% range. But crucially, they still expect profitability to improve and to generate positive operating leverage through 2026, mostly thanks to those margin tailwinds from assets repricing. And let's not forget credit. It's still rock solid. Net charge-offs were super low, just 0.16% annualized. The CEO even specifically pushed back on any broad credit crack worries, highlighting their cautious approach, especially with non-depository financial institutions. They're keeping that private credit exposure pretty limited.
Okay, last piece then. M&A. It's third on their list. Any hints that it might move up?
Well, there was definitely a strong hint. Management said they're seeing, and I quote, more people raise their hands to sell than in the last couple of quarters. Now, they still say they'll be conservative, opportunistic, but more sellers, that's often a leading sign. And with that hefty 13.4 per CET1 ratio, UCD certainly has the firepower to act if they see a good fit.
All right, let's shift gears. Welcome to our not financial advice segment. Here's where we take that wheel disconnect, great results, flat stock, and cook up an outrageous but maybe plausible trade idea based purely on the call dynamics.
Right. So the core idea, the thesis, is pretty straightforward. The market's being short-sighted here. It's totally fixated on that immediate Q4 speed bump, the $1.8 billion CD repricing, hurting NIM for a moment. And it seems to be completely ignoring the bigger, longer-term lift from that $1.4 billion in assets rolling over into higher yields, plus management clearly saying they expect positive operating leverage into 2026. So the pitch. It's a calendar spread. Basically, play defense short-term, but get bullish and leveraged long-term. You might, for instance, sell some Q4 calls, collect some premium, acknowledging that near-term NIM flatness might create some chop or keep a lid on things for a bit.
Okay, sell short-term calls and then go long further out.
Exactly. At the same time, you could look at establishing a longer-dated, leveraged long position, maybe deepen the money calls targeting, say, Q2 or Q3 of 2026. The bet is that eventually the market will price in the full benefit of that 2026 asset repricing cycle and the sustained operating leverage they're aiming for. And the fact they just redeemed preferred stock and raised the dividend, that shows management's confidence in those longer-term earnings, backing up the play against this temporary market anxiety.
That's a really interesting way to frame that structural shift versus the quarterly noise. So wrapping up our deep dive, UCB put up a really strong Q3. Great operating leverage, solid margin expansion because they managed funding costs well, they cleaned up their capital structure, and credit quality looks pristine despite everything going on.
Yeah, the main takeaway is UCB seems positioned for some nice margin tailwinds starting mid-next year. But here's a final thought for you to chew on. They made those big capital moves, the preferred redemption, and they have that super strong 13.4% CET1 ratio. So how soon before M&A number 3 on their priority list actually becomes a major growth driver? Especially if, as they hinted, more banks are starting to look for buyers. That could be the real wild card next year.
Good point. All right, thanks for tuning into this deep dive on UCB's Q3 2025 earnings. We'll catch you on the next one.